Hello everyone and welcome to New Jersey Homebuyer Seminar. Thank you for joining us and taking the first step in setting yourself up for success on a home purchase. My name is Adam Witzburg and I'm a loan officer and first-time homebuyer specialist with Primary Residential Mortgage, Inc. All of my contact information is listed here. If anyone out there has any personal questions or unique situations that they're looking at coming up with their first home purchase, please feel free to take down my information and I'm happy to answer any questions you might have about the process. The topics we're going to cover in this homebuyer seminar are going to be the benefits of homeownership. We'll discuss current housing market conditions and what you can expect as you're shopping for homes. We'll talk about what it takes to buy a home, credit scores, and how that's going to affect the home buying process. We'll discuss mortgage pre-approvals and available mortgage programs. Lastly, we'll discuss how to go shopping for a home. Before you go any further in the home search, the absolute first and most important step in the process is you need to determine how much can you afford to spend. So here we're talking about your budget. And there's two parts of the budget that are going to be absolutely critical that you have these firmly cemented and planned out so that you can set yourself up for success. The first is your monthly budget. How much can you afford to spend on a month-to-month basis for your home? The fact of the matter is that a lot of lenders are going to be able to approve you for a higher monthly payment than you're comfortable spending. So ultimately, you don't want to just walk into a mortgage company or a real estate office and say, how much loan can I afford to spend? How much money can you get me? Because a lot of times you might not be comfortable with the payment. What you want to do is determine your monthly budget, how much you can afford to spend, and then tell them, I'm comfortable spending $1,500 a month. I'm comfortable spending $2,500 a month. And let them tell you what price range and property taxes that equates to so you know that you're shopping in the right price range for your home. The second portion of the budget is going to be your out-of-pocket expense. How much can you afford to spend out of pocket between down payment and closing costs to get in the door of the property? Once you have those two portions of your budget clearly defined, then you want to go to your realtor or your mortgage professional and let them tell you what price range you should be shopping in. Let's talk a little bit about the benefits of owning a home. So first, your home is going to be a very valuable investment tool for you. We'll talk about how you can use that to your advantage. If you're currently renting, you probably know that rising rents year after year, your landlord shows up and tells you that your rent went up again. It's obviously a drawback of not being a homeowner compared with the benefit of having a fixed rate mortgage. So many of you as first-time buyers or whether you've owned a home before, you'll be locking in a long-term, possibly 30-year fixed rate mortgage payment, which will provide some stability. So we'll talk about that. Your home's going to be an appreciating asset for you. And also, we're going to talk about the tax benefits that you'll see as a homeowner that you're not currently seeing as a renter. Why do people want to buy a home? Well, first and foremost, the number one reason that people want to buy a home is to build equity. And what is equity? You're going to hear that term thrown around as you're shopping for a home. Equity is the money that you have locked in your home. It's the difference between what you owe on your mortgage and what you can sell your home for. So a simple equation here is your home value minus your mortgage amount equals the equity in your home. Now, what you have to keep in mind is that accessing equity in your home is not as easy as walking down to the bank and putting in your ATM card to pull out money. So if you're trying to access the equity in your home or that value, there's really only a couple ways to do it. The first is going to be to sell your home. Obviously, selling your home takes time, it costs money, and ultimately you need another place to live, so that might not be the best option for you. Or there's home equity loans, cash out refinance loans, but these are mortgages and you have to qualify for those loans. So what we're trying to show here is it's not necessarily easy to access the equity that you have in your home, but it is value that is, in your asset. As far as managing equity is concerned, a lot of times people come to me at the mortgage company and they say, Adam, how can I build equity in my property? And what I'll tell them is, you're going to build equity a couple ways, but the most common way is through property appreciation. So year over year, the value of your home will increase. And also simultaneously, while the value is going up, you're also making payments, so you're paying down your loan. So you're building the gap between what you owe and what your home is worth. That's how you're going to build equity in the property. One of the most common questions we get at the mortgage company is, should I make extra payments on my mortgage? And really, it's not a cut and dry yes or no answer to that question, but you just have to understand what you're doing when you make those extra payments. Any extra money that you send to your mortgage payment, if your base mortgage payment's $2,000 and you send $2,500, that extra $500 goes directly to the principal balance of your loan, not towards interest. So it's going to help you to pay off your mortgage that much more quickly, but it's not going to change your monthly mortgage payment. That'll always remain fixed. So should you make extra payments? Well, just realize that when you make those extra payments, what you're doing is you're building equity in the home. And so I don't necessarily recommend that you make extra payments unless you've considered these, financial steps first. First and foremost is going to be to establish the emergency fund. So you want to take your total monthly budget, not only for housing, but for all of your other expenses as well, and multiply that by 6. Establish your emergency fund with 6 months of expenses. The reason you want to do this, and any financial planner will tell you this is absolutely one of the most sound things you can do financially, is because if anything were to happen to you and you're unable to work, if you have 6 months worth of living expenses set aside in your account, you at least know that you have time to get back on your feet. You can pay your mortgage, your car payment, get groceries, all of the things that you need for yourself and your family. Now, if you've been sending all of your extra money to your mortgage and it's all trapped in your home in the form of equity, and you lose your job, if you go to the bank and say, I need to pull some equity out of my home, the first question they're going to ask you is, well, what do you do for work? And so you have to realize that it's not necessarily the easiest thing to do to access that equity, and you might want to protect yourself by establishing an emergency fund first before you start making those extra mortgage payments. Other steps that you might want to consider: establishing a 401k or retirement account either through your employer or on your own. Your home's not necessarily going to pay you in retirement, but you probably will still have expenses, so I definitely think it's a good idea to set up some type of retirement account. You could speak with someone about life insurance. If you're the primary source of income for your family and anything were to happen to you, for a relatively inexpensive amount of money, you could probably, if anything were to happen to you, have your family receive enough money to at least pay for their house, pay off the mortgage, things like that. Additionally, saving an extra 10% of your paycheck for future investments, things like educations for your children, things of that nature, it definitely also could be a good idea. But ultimately, you know your financial picture best, and so just realize if you want to make extra payments in your mortgage, know what you're doing. You're building equity, and if that fits into your financial picture, it's absolutely a good idea to have equity in your home. Let's take a look, because I think it's important to see, a lot of people get stuck in this pattern of renting homes year after year after year. But I think when you see what it's actually costing you over the long term, it can help you to realize how important it is to be, owning a home as opposed to renting. So let's take a situation here of someone renting a home for $2,000 a month. Considering a 5% annual rental increase over that 5-year period, starting at $2,000, after 5 years with the increase, you would have invested roughly $132,000 in rent, which is obviously a significant amount of money. This is basically money that you're, contributing to somebody else's mortgage payment. So if you're going to be spending the money, it's obvious that you might as well be investing that money in yourself and in your own real estate as opposed to somebody else's. So let's compare that with the equity buildup that you have in a home with a 30-year mortgage over the same 5-year period. If you bought a $250,000 home and started with 5% equity or a 5% down payment, same thing, over that same 5-year period, you would have built up roughly $70,000 in equity in your own home. So, take your pick, $130,000 in rent to somebody else, or building up $70,000 in equity in your own home. I think the choice is pretty clear. Over a 10-year period, you would have built up roughly $160,000 in equity. So obviously, you can see the benefits of having a home that you own as opposed to renting from somebody else. One of the most common things that I hear is that, comparable homes, the mortgage payments are a little bit more expensive sometimes than maybe what you're paying for rent in a similar home. But what you definitely need to factor in the equation is the tax benefits that you're going to have as a homeowner as opposed to a renter. So let's take a hypothetical situation here. We have a married couple with $100,000 in combined income. Their federal tax rate might be about 25%. Now, if they had a 30-year fixed-rate mortgage at 4.5% and a $250,000 loan, over that first year, their interest would total about $11,000, $11,137. And if you had property tax of about $9,000, which, in New Jersey, that can happen. We do have high taxes. What you get to do is you get to deduct your interest and your total property taxes from your taxable income. So instead of paying taxes on $100,000, you're paying taxes on $79,863 in this scenario. So it's either a tax bill of $25,000 as a renter or a tax bill of $19,900 as a homeowner. So that's tax savings about $5,034 per year, or about $419 a month. Now, keep in mind this is definitely a rough estimate. It's not exactly how the calculation is going to work out, but you are deducting your mortgage interest and your property taxes from your overall taxable income, so it's a significant benefit. So just keep in mind, if you're renting right now for $2,000 a month, but your mortgage payment's going to be $2,200, when you factor in the tax savings that you're going to have, you might actually net savings overall because of the tax benefits. So definitely something to factor into the equation when you're considering buying. Let's change gears and talk a little bit about the current housing market, what you can expect as you're out there shopping for homes. Currently, as of April 2016, mortgage interest rates are at or near historic lows, hovering right around 4%. And just keep in mind that this is, compared to 2007 when interest rates were about 7%, which was low at the time. Just keep in mind that now is a very affordable time to borrow money to buy a house. Interest rates are on the rise. They're predicted to head up, a little bit above where they are now. And home prices are definitely on the rise as well, rebounding from some of the trouble that we had in the past. So we're definitely seeing an increase in those areas. Housing markets in the areas that you're looking are going to be tied to the jobs in the areas that you're looking to purchase a home. So New Jersey has a very competitive housing market because of our proximity to New Jersey. It makes for very strong home prices and appreciation rates and competitiveness in that housing market. We're still well below those 2006 peak prices, so there's definitely still a lot of good deals available on the market. But the problem that a lot of people are seeing out there is that we do have low inventory. So there's few homes on the market in certain price ranges. So, for example, if you're looking at a home that's $250,000, 3-bedroom, 2-bath, and that's exactly what you can afford, just keep in mind that there might not be a lot of homes that meet that criteria. And so there may be a lot of other people looking in that exact same price range, which can make for very competitive home buying situations. Definitely want to keep this in mind when you're considering, making offers on homes, because if there's multiple offers, you don't want to go in with too low of an initial offer. You want to make sure that you're going in with a competitive bid so that the sellers are willing to negotiate with you and not ignore your offer for somebody else who went in a little bit higher than you. One of the big things that you're going to see as you're shopping for homes is you're going to see short sales, foreclosure, and bank-owned properties. And so I think it's important that you understand how you can go about buying those. Now, short sales you're going to be able to buy with a regular mortgage loan. So all of the information we'll talk about coming up here is going to apply to buying a short sale, and you will see a number of those properties on the market. But what you have to understand is that a short sale is a little bit difficult to buy for a couple reasons. Let's say, for example, that you see a short sale and it's listed for $300,000 is the asking price. What that means is that the person selling that house knows that it's worth about $300,000, but that they owe more than $300,000 to their current mortgage lender. So maybe in this case they owe $350,000. So what they do is they'll agree to take your offer for $300,000, but then they have to go and negotiate with the bank that they owe that $350,000 to take less money than they're owed. So the problem here is that banks don't want to take less money than they're owed, and that process can take months and months. Short sales, to get from the time you sign a contract to when you go to the closing, it can take 8 months to a year for that bank to come back and tell you whether they're willing to sell you the property for that amount or not. And so if you're buying a house and you have a specific time frame in mind, you want to avoid a short sale because they're open-ended transactions. There's no guarantee as to when you're going to be able to close, and so just keep that in mind. If you need to move quickly, you want to avoid the short sale. Now, foreclosures are properties that you can buy. A house that has been foreclosed on, okay, so it's gone through the foreclosure process and is now a bank-owned property. If it's listed for sale for $300,000, you can buy it for $300,000 and move relatively quickly. It's not you don't have to go through that lengthy process. So a foreclosure, a house that has already been foreclosed, then becomes a bank-owned property. They're essentially the same thing. The properties that you have to watch out for are what's called pre-foreclosure or auction properties. Those are properties that are not yet going through the foreclosure process. They're not quite finished, and it can be a lengthy amount of time before they're actually available for sale. So if you see pre-foreclosure or auction properties, they're really looking for cash buyers, people willing to come in and pay all cash for the property. So short sales, foreclosures, bank-owned, you can buy them. Just keep in mind how you're going to go about doing that and the length of time it might take. Now, I think it's important that a lot of people, recognize how affordable it is to buy a home right now compared to the cost of waiting. So let's take a look at a couple scenarios here just to see, current market conditions versus waiting 1 year, what might happen to those mortgage payments if you wait and conditions get a little bit worse. So if you're buying a $150,000 house and your interest rate was about 4.25% with this criteria you see here, your total payment might be just under $1,500. If you waited a year, the home value goes up 4% and your interest rates go up 1% from 4.25 to 5.25. That same mortgage for the exact same home could cost you an extra $115 a month. In a $250,000 price range, it could cost you an extra $185 a month. In a $350,000 price range, it could cost you an extra $261 a month. And $450,000 above, waiting, if this criteria takes place, interest rates go up and home prices go up, it could cost you at least an extra $300 to $400 a month for the exact same home just by waiting that 1 year. So what we're trying to show here is that it is a very affordable time to buy a home. If you can afford to do it now, take advantage because conditions are so good out there for home buyers. So what does it take to buy a home? As many of you are well aware, it's going to require a loan. And the first step that you want to take in the home buying process, right after you determine what your monthly budget is, you want to go through the mortgage pre-approval process. You do not want to assume that you qualify to buy a home, because that's when you get into those situations you hear, horror stories from neighbors or friends or family where they went to buy a house and, it took months and months, or maybe they got denied for the loan. And it's because they didn't take the time to do a thorough mortgage pre-approval from day one. And so you really need to be careful that you're doing an actual mortgage pre-approval and not a pre-qualification. Pre-qualifications are essentially worthless. They're valuable in that they'll give you an idea of what your credit score is, and possibly you'll get some information about the process. But pre-qualified means that a lender looked at your credit and you told them how much money you make. The thing is that there's so much more information that goes into the home buying process besides those two things. You're going to have to look at all of your income information. Ultimately, the mortgage company is going to review a lot more documentation than just your income and your credit report. And so when you do a pre-approval, they're going to review all of that information day one. The pre-approval involves a credit check. You'll talk about your income, but you'll also provide documentation to verify that. So this is things like pay statements, tax returns, W-2 forms, 1099s. If you have any businesses, we're going to require all of the tax returns for your businesses. This is what the mortgage underwriter, the person who has the authority to approve your loan and get you the money to buy a house, this is the information that they're going to review when you actually go to get approved for your loan. And so it makes all the sense in the world that you get that stuff reviewed day one so that you don't have any surprises down the road. Wouldn't it be better to figure out if there was a potential issue, months in advance when you start shopping for a home, as opposed to, a week after you agree to buy a house, sign a contract, and give them $2,000 right up front to say that you're going to buy their house? Ultimately, what you're doing here is you're protecting yourself to make sure that you're not spending money that's going to be wasted and that you're not going to be able to get it back. So you want to make sure that you go through the pre-approval process, make sure that you're providing and that they're requesting the documentation. A lot of the big banks out there are notorious for just issuing pre-qualifications, and then they're going to ask you for all of this stuff down the line. So it's important that you make sure you have someone doing a pre-approval, that they're reviewing all your information, and that you're not going to have any surprises moving forward. So when you do your mortgage pre-approval, these are the things that the lender is really looking at to determine if you're going to qualify to buy the house. The first thing is a steady source of documented income. Do you have all of your monthly bills paid on time? Do you have the ability and willingness to pay your debts? Do you have sufficient credit history? Are you a renter? Do you have rental history that you can verify? That's not required, but it can definitely help you to qualify if you're on the fence about whether or not they can approve you. Do you have consumer debts like car loans, student loans, credit card debt? All of these things are going to be important, and the lenders are going to look to see if you have them. Cash to close. So do you have your down payment, closing cost money prepared, and where's that money coming from? It's very important, and they're going to look at your assets very closely. Do you have reserve funds, so any extra money in the bank on top of what you're going to be spending for down payment and closing costs? And again, at the end of the day, those mortgage companies, they're selfish. This is what they're trying to figure out. Do you have the ability to pay your mortgage every month? They want to make sure that they're going to get their money back and that they're not going to have any problems with your mortgage payments. As far as what type of mortgage fits you best, this is going to be determined when you do your mortgage pre-approval. So as you go through the pre-approval process, you'll determine what your loan to value is going to be. So how much down payment are you doing? So if you do a 10% down payment, your loan to value would be 90%. What's your debt to income ratio, and does it meet Fannie Mae conventional loan guidelines, or is it going to be an FHA loan or a VA loan? So your debt to income ratio is how much your mortgage payment will be compared to how much your gross monthly income is. Also, they're going to take into account those other monthly debts and determine your front and back debt to income ratios and which program you'll fit into based on that information. The three deciding factors when it comes to qualifying for a mortgage that we're looking at is going to be your income, your assets, and your credit. Now, when it comes to income, what kind of criteria do you have to make sure that your income's okay to buy a house? Stable employment history for 2 full years is really the base that all of the lenders are going to be needing to document. There's some exceptions. For example, if you're in college or you're in a special degree program and you just graduated and got your first job, you only have to be employed for about 6 months until you're eligible for a loan if you can prove that you graduated and got that degree. Now, if you're a self-employed home buyer, you have to be able to provide 2 years of tax returns. So your taxes have to be filed for 2 full years to be able to count your income, because that's what they're going to average and go off of to determine what your income is for the loan. You got to be careful of the income trap. So a lot of times people will come to me and they'll say, Adam, I just got a second job, I want to buy a house and use, my income from both jobs to qualify. What you have to realize is you can only count a second job if you've been at 2 jobs for 2 full years. And so some people have worked 2 jobs for many years and we can count their income. Some people, they just picked it up a couple weeks back, and you're not going to be able to count that income from the second job. So be careful of that. Seasonal employment. So for example, many teachers, a lot of times, they'll have a separate job in the summer while they're not working for school, and you can count that seasonal employment as long as it's verified that you've done it for 2 years and that you're going to continue doing it in the future. Be careful of declining income. So if your income dropped from one year to the next for any reason, make sure that you talk to the lender about it and make them aware of it, because that could definitely affect how much you're able to qualify for, and we got to make sure that we look at that very closely. Changing jobs is something, a lot of people are always out there looking for, a better job, better employment, salary, and stuff like that. And you don't want to put yourself in a situation where changing jobs can affect the home buying process. So changing jobs is good when you're, going through the home buying process. If you go from a job making a salary of $50,000 to a job where you're making a salary of $75,000. When changing jobs is bad, it's bad when you change jobs and the way that you get paid changes. For example, if you're buying a house and you start out with a salary of $50,000 a year, and then you get a new job where you're making $100,000 a year, but it's all commission income, that would be bad because they have to average that commission for 2 full years. And so if you haven't received commission for 2 years, you're not going to be able to count any of it. So just make sure that if you're changing jobs that the way you're getting paid isn't going to change, and make sure you talk to your lender about it so that there's no surprises, as you're going through the process. Assets are a very important topic. So this is the money that you're going to be using towards the purchase of a property. So one of the biggest things that we see at the mortgage company that gets people in trouble as they're going through the home buying process is large deposits into their bank account. The government requires that all mortgage companies track any and all money that they have going into their bank accounts. And so things like work paychecks and tax returns, those are absolutely fine. But you have to be careful of any other money that's going in. Any deposits over, roughly $500, the lenders are going to ask you, where did this money come from? And so what you want to do is you don't want to be depositing any money into your bank account. For example, if you have $10,000 saved at home in cash that you want to use to buy a house, and you want to deposit that money into the bank, it could be very, very difficult, if not impossible, for you to use that money. So if you do have money that you need to deposit into the bank and it's sitting at home, really the best way to use it is to put that money in the bank and let it sit there for 60 days so that you have 2 bank statements that don't show that deposit. The lenders are only going to look at your most recent 2 bank statements to determine what deposits you have in your bank account. So if you need to put money in the bank, it's better to put it there, let it sit there for 60 days so that you can show your mortgage company 2 bank statements that don't have any large deposits. If you sell anything, you want to make sure that you write up a bill of sale and receive the funds via check. Cash is always going to be a problem going into your bank account. If you don't have direct deposit, don't deposit portions of your paycheck in your bank. So if your direct deposit, your net paycheck is $1,500, don't deposit $1,200. Make sure you deposit the full $1,500 and then withdraw money in a separate transaction. You can't borrow money for down payment on a property, so you can't, take out a loan for your down payment. You also can't, borrow money from a relative. But what you can do is you can get a gift. So if your uncle wants to give you $10,000 as, towards the purchase of a home, he has to sign a document that says this is a gift and that you're not required to pay it back. Ultimately, down the road, whatever you do, the lenders aren't going to come check on you as far as what you did after you bought the home, but the person giving you a gift has to sign a legal document saying that you're not required by law to pay that money back. A quick tip, if you're a little tight on funds for down payment and closing costs, a great source of funds that a lot of people use as first-time buyers, and you're not necessarily even having to be a first-time buyer, but you can do this, is you can access funds from a retirement account or pension through your employer, and you can probably borrow that money from your retirement account with no financial penalties. So if you need a little bit of extra funds to help you to buy the house, the 401k or retirement account can be a great place to look to see how much you might have access to. Credit is obviously a big topic, so we'll discuss the credit that you need to get a home today. Mortgage companies are going to be utilizing your FICO scores, so those scores are going to be ranging anywhere from 350 to 850. And the score is going to be determined based on the number of trade lines or accounts that you have on your credit report. How long those accounts have been open, the longer the better, the higher your score will be if your accounts are open for a long time. And the health of the trade line, is it on time, is it late, is it past due? What's the status of all of your accounts? The minimum credit score that you want to target when you're buying a home today is 620. Now, if you're close to 620, a little bit below there, don't be discouraged, because there's things you can do, with some of your credit card balances that you might be able to get your score up very, very quickly, in just a week's time by manipulating some of the balances on your credit card. So you want to target 620. There's programs below 620 where you can qualify, 580 and above. But it's a little bit more difficult when you're below 620. So if you had a benchmark, a goal that you wanted to set for yourself on your credit score, it should definitely be 620. We're going to use the middle credit score out of the three. So when a mortgage company pulls your credit, they're going to get 3 credit scores and use the middle as the credit score for the decision on your loan. One thing you got to be careful of is, many of you out there tracking your credit scores online, you're looking at what we like to call your FICO scores. These are not your actual FICO scores that your mortgage lenders are going to get. Now, a FICO score, what that is, sites like Credit Karma, freecreditreport.com, the credit score you get from your Discover card, whatever it might be. Your credit scores are going to come from a number of places, but they're not going to be the same as the mortgage company gets. The reason is because mortgage companies have a specific equation that they run, which those companies aren't using. They're giving you a generic score. Mortgage companies have an equation, car companies have an equation, credit card companies, student loans, they all run your credit a little bit differently. So when they're giving those credit scores online, they're giving you scores somewhere in the middle. So, until you get an actual mortgage FICO credit report from your lender, expect variation in your credit score from what, from what you see to what the lender's going to get. It's very common that someone walks into my office, they say, Adam, my score is 650. I looked on Credit Karma and I run their report and they're actually at 680. So sometimes it's better. But sometimes they say their score is 650 from Credit Karma and it's actually 615. And so you have to go into a lender, get an actual mortgage FICO credit report so that you know exactly where you stand, because you definitely can't, assume that you qualify based on your score from these online credit reporting companies. As far as how is credit going to affect your home buying process? Well, perfect credit for a mortgage loan is 740 and above. And your credit score determines the type of loan that you qualify for, as well as the interest rate that you're going to be offered. So the higher your FICO score is, the lower the interest rate you're going to get. If you have a lower credit score, you're going to get a higher interest rate because it's considered riskier to the lender. As I said, for the different loan programs that are available, you want to target that 620 benchmark for your credit score just to make it as easy as possible to qualify. There are programs below 620, but it's definitely going to be a lot more difficult, so you do want to target that 620 mark. Can you get a mortgage with no credit today? The answer is no. You have to have positive credit and credit scores to get a loan. And so if you don't have credit right now, or you want to build your credit a little bit more quickly, here's some tips that I would give you to do that. The number one thing you can do is establish positive credit. So that's going to be through credit cards, secured or unsecured. You want to pay everything on time. One late payment on your credit report can drop your score 75 points. So if you spent the last year building your score from 550 to 625, and everything was on time, one late payment can knock you right back down and erase a year of progress. So set up those minimum automatic payments on all of your accounts so you don't have to worry about it, and just know that everything's going to be on time, and it'll save you a world of trouble and a lot less risk with your score dropping. A quick thing that you can do to help boost your credit score if you need to is if you have somebody that you know that you trust who has a good credit card or account, with a long on-time payment history, a low balance, then you can get added onto their account as an authorized user or a joint applicant. And the benefit of doing this is you'll get all of their positive credit history from that account to help your credit score get boosted up. And so that's definitely something significant you can do to get your credit scores up more quickly. Big recommendation. One of the things that I hear often as a mortgage lender is, they'll say, Adam, before you run my credit, I have a few things I want to clean up on my credit report. And to me, what that says is that they have some old collections on their credit report that they're going to go pay off. And I would definitely not recommend paying off all of your old collections all at once before you let a lender look at your credit. Here's the reason. Collections are going to hurt your credit based on the date of last activity on your credit report. So the date of last activity on those collections, if you haven't made any payments on them, is going to be the day that it hit your credit. And so if you had a collection for $100, it hurt your credit the day it went there. If you pay the collection and they update the balance to $0, it's actually going to drop your credit score in the short term, and then long term you will see it go up. So what I would actually recommend is let the lender look at your credit report first before you pay off those collections. If you get over a 620 credit score and you have some collections that you need to pay, the lenders will tell you which ones you need to pay, and you can pay them, but they won't run a new credit report after they're paid. So you can pay them off, keep your same credit report, and just get proof that they're paid. And then you might even be surprised to find out some collections don't have to be paid. Certain collections don't have to be paid prior to closing. So you can just leave them on your credit report and deal with them after you close on the property. So I would definitely recommend let the lender look at your credit report first. They'll tell you what you should and should not address, and it can save you, a lot of time and energy with your credit score dropping if you pay off all those old collections. Now, one of the questions I get a lot as well is, do credit repairs work? Can you pay for a service to repair your credit? Basically, if your score is below 550, it's definitely something to consider as far as doing the credit repair process, but it's a case-by-case basis. Sometimes it just takes building up positive credit, but sometimes it's going to require somebody going on and disputing all your old stuff and getting some of that old junk off your credit report. So if you need a credit repair, if you're below 550, let somebody look at your credit and give you a recommendation before you spend the money to do that. Now, as far as the types of homes that you're going to be shopping for, you're going to be looking for anything that's considered a residential home. This is going to be a 1 to 4 family property. It could be a condo or it could be a townhome. Any of those will qualify as a residential real estate purchase. Anything with 5 units and above is considered a commercial property, and all of the rules will change. So you want to make sure that as your first-time home buyer or just looking to buy residential real estate, make it as easy as possible, that you're looking at something that's considered a residential home. The types of loans that you're going to be looking at as a residential home buyer, most likely you're going to be looking at a 30-year fixed rate loan. It's the most common type of mortgage that people will take out today, just because it's going to give you the most stability, keep your payment as low as possible, and you're going to lock it in for a fixed rate term of 30, 20, or 15 years. If you want to do a shorter term of 20 or 15 years, they're definitely available, but just keep in mind it's going to make your mortgage payment a little bit higher. There's adjustable rate mortgages as well. You could have a 5-1, 7-1, or 10-1 ARM loan, which stands for adjustable rate mortgage. Just keep in mind that those come with risk, and they're not as common today. So most people are doing those fixed rate loans. There's loans through the Federal Housing Administration, which is an FHA loan. There's conventional loans through Fannie Mae and Freddie Mac, and there's also VA loans if you've served in the armed forces for our veterans. Basically, every buyer has a unique situation, and so you just want to make sure that you give your full situation to your lender when you go through that mortgage pre-approval, and they're going to give you the options available that make the most sense for you financially on your upcoming home purchase. Now, FHA loans, we're going to definitely talk about these in detail because FHA loans are probably the most common first-time homebuyer loan available. When you hear about first-time homebuyer programs, people are talking about FHA because this loan is geared mostly towards first-time homebuyers. It's not restricted to first-time home buyers. You can have owned a home before and still use an FHA loan, but it just tends to be geared towards people who are buying for the first time. So an FHA loan requires a minimum investment of 3.5% down payment. For example, if you're buying a $200,000 house, that would be $7,000 down payment. If you're buying a $300,000 house, that would be $10,500 down payment. If you're buying $400,000, it's up above $12,000 for your down payment. But just keep in mind, you do have to make that investment in the property. FHA does require a down payment. Now, one of the really cool things about FHA is up to 100% of your down payment and closing costs can be gifted from a relative, meaning that you can have a relative contribute the funds to help you to buy a house. You don't have to have all of that money yourself. FHA loans do have what's called mortgage insurance, and there's two portions of the mortgage insurance. There's an upfront mortgage insurance cost, which is a fixed fee based on your loan amount that will be added onto your loan. Okay, so that's a fee that goes right to FHA, to the government, to fund the FHA program. And there's also a monthly fee for mortgage insurance, which is added into your total monthly payment. So what mortgage insurance is anytime you put down less than 20% down on a property, you're going to have to pay some form of mortgage insurance. And so with FHA loans, you have two portions, the upfront cost and then the monthly cost as well, which will be included in your total monthly payment. Now, one of the other unique features of the FHA loan is that the seller can help you with your closing costs. So the seller can contribute up to 6% of the purchase price in closing costs. And so in New Jersey, because of where our property taxes are, and because a lot of times we have attorneys involved in transaction, the closing costs are not cheap. Your closing costs can range anywhere from $8,000 to $12,000, so they can definitely get up there in price. So one of the really unique things about FHA and why a lot of people like it is because they'll negotiate to have the seller pay those closing costs for them. So you only have to worry about making that minimum investment of the 3.5% down payment and let the seller cover the rest for you. And that's just part of the negotiation. When you offer to buy their property, your realtor will negotiate those closing costs in there for you. FHA is going to be, again, you want to target that 620 credit score to make it as easy as possible to qualify for your loan. One of the best things about FHA is that makes it geared towards first-time buyers is that if you have existing debt, credit cards, student loans, car loans, FHA is going to be a lot more lenient when it comes to qualifying to help you to buy this property. So that's one of the other benefits as well that you'll see. If you're trying to buy a condominium, okay, then you probably want to get qualified for a conventional loan because very few FHA loans allow for condominiums. Most condos don't accept FHA loans and they're not approved for FHA lending. FHA will allow you to have a non-occupant co-borrower. So if you have somebody who's helping you to qualify to buy a house who's not going to live there, FHA doesn't have a problem with you doing that. There's also a unique product called a 203K loan, which is an FHA renovation loan where you can add improvements and finance, construction and repair costs into your mortgage loan to be done after closing. So that's a unique product as well. And if you've had a bankruptcy in the past, you have to wait 2 years until you're eligible for the purchase of a home. And if you've had a short sale or foreclosure, you have to wait 3 years until you're eligible to purchase a property with an FHA loan. Now, there's also another product called a conventional loan. This is through Fannie Mae and Freddie Mac. This is going to require a minimum down payment of 3 to 5%. But if you want to avoid mortgage insurance, you're going to be putting down a 20% down payment. Now, with conventional loans, you have to have 5% of your own money. Okay, so you have to be able to show that you have 5% of funds in your own name, and then the rest can come from a gift from a relative towards down payment and closing costs. Conventional loans are going to be a lot more strict when it comes to the credit score. So even if your credit score is 620, 630 or 640, it's going to be a lot more determined by the computer underwriting system from Fannie Mae and Freddie Mac than it will be just your credit score. Conventional loans are going to be a lot more strict when it comes to your debt to income ratios as well. Most of the time they're capping your debt to income ratio at 45%, which makes it more strict than FHA, which says you can go up to about 55%. So definitely going to be more strict if you have existing debt like car loans and student loans, things like that. Interest rates are going to be significantly affected by credit score when it comes to these conventional loans. If the best rate today for a conventional loan is 4% and your credit score is 740, you're going to get 4%. But if your credit score is 625 and you're trying to do a conventional loan, your interest rate could be 4.75% just based on your credit score alone. So definitely going to see a lot more restrictions and higher interest rates on conventional loans based on credit scores. If you've had a bankruptcy or short sale in the past, you have to wait 4 years until you're eligible for a conventional loan. If you've had a foreclosure, you have to wait 7 years until you're eligible for this new conventional loan. Basically, the rule of thumb is if you can qualify for a conventional loan, it does make more sense financially. It just so happens that most and a lot of first-time buyers are going to be, more qualified for the FHA loan because of the criteria that we mentioned as to why FHA makes it easier to qualify. So when you do your mortgage pre-approval, let your lender give you both scenarios, the benefits and drawbacks of each loan and which one makes the most sense for you. And a lot of times people have a decision if they want to do a conventional versus an FHA. It's up to them. So you can take a look and just determine what makes the most sense for you financially and go with that. If you're a veteran and you've served in the armed forces, first we'd like to obviously thank you for your service, but also we want to make you aware that you do qualify for the best type of loan available, which is a VA loan. So this is for anyone who has an honorable discharge from the military. You can qualify for the VA loan. You do 100% financing, so you can do a 0 down payment and still have no monthly mortgage insurance. So like I said before, if you're putting down less than 20% and using an FHA or conventional loan, you'll pay some mortgage insurance. But if you're a veteran doing a VA loan, you can do 0 down payment with no mortgage insurance and save money on your monthly payment. It's very similar to the FHA program with some slight differences in between, but if you do have VA eligibility, it's a great product that you should qualify for. Now your mortgage payment every month is going to be made up of what's called your PITI, and we'll add MI into that as well for many of us doing less than 20% down payment. So that's your principal, your interest, your taxes, and your insurance, and the mortgage insurance as well if you do less than 20% down. That's what makes up your total monthly mortgage payment. Don't forget about homeowners association fees. So if you buy a condo, make sure you factor in those HOA or maintenance fees into your payment. One of the really cool things about owning a home is that your mortgage is due not on it's due on the 1st, but you have until the 15th to pay it. So you can pay it around when you get paid and your paychecks come in, as opposed to rent where if it's after the 5th, you get a late fee on there. Anything after the 15th will have that late fee. Anything after 30 days late will be reported on your credit. So you always want to make sure that you pay your mortgage on time. When it comes to interest rates for mortgages, they're going to be offered in 1/8 of a percentage. So you'll see 3.75, 3.875, 4%. You're not going to see, anything in between there. That's just how it's done. And there'll be all of these factors that you see listed here: the type of loan, your credit score, down payment, the type of property that you're buying. All of these factors will go into your interest rate. So you want to make sure that you don't just want to call up a lender and say, "What's your interest rate today?" Because they're not going to be able to give you an accurate rate unless they know all of the information you see listed here. How long is your interest rate quote good for? It's good for as long as you're having that conversation. By the time you hang up the phone, that rate could be different. Not because the lenders want to change the rate on you, but because the market changes every second of the day a little bit. They go up, they go down. It's always changing slightly. And so you're not guaranteed any interest rate until you do what's called an interest rate lock-in. So once you have the conversation with your lender to lock in the interest rate, you can't do this until you know when you're closing on your home. So once you have a closing date set and you've agreed to buy a property, then you can start talking about locking in your interest rate. Now, one of the things that you'll see when you see interest rates, you'll also see APR. So how does that affect your loan? APR has nothing to do with your monthly payment, but what it does do is it takes into account the interest rate that you're getting offered as well as the costs associated with doing the loan. So let's say you talk to lender A and they offer you a 4% interest rate on an FHA loan. You talk to lender B and they offer you a 4% interest rate on an FHA loan. How do you know which one's a better deal? Whoever has the higher APR, in theory, has higher costs associated with doing the loan. It could be the difference of an application fee from one lender is $100 more than the application fee for the other lender. It just depends. But you want to, talk to the lenders and just compare those scenarios if you're looking at two different people, just to make sure that you understand what the difference in costs are. Now, when in relation to cost, the most important document that you want to get from your mortgage company is going to be your loan estimate. It'll be a detailed breakdown of all of the costs associated with the transaction. So you want to get your loan estimate and make sure that you get a worst case scenario. You don't want somebody who's going to tell you, "Oh, your closing costs, we can get them down to $7,000. Don't worry about it. It's going to be, we'll get you a good deal on your closing costs." The fact of the matter is that the closing costs essentially are what they are. They're going to vary very slightly from lender to lender, and there's certain things that you have to pay. So wouldn't you rather know, if you have a lender tell you they're going to be 7 and then the day of closing you show up and it's 9,000, nobody likes to spend more money. So you want to make sure you say, okay, what's the worst case scenario? How much money could I possibly need? Let them tell you what the worst case is so you can prepare for the worst, and then hopefully it's a little bit less the day of closing. I think that's the safest way to do it. Again, to set yourself up for success so that you're not overextending yourself financially, just when you're surprised because the lender tried to get you in the door and tell you the cost would be less, but ultimately they worked out to be higher at the end of the day. So make sure you get that worst case scenario loan estimate. There's really no secret when it comes to reducing these fees. So if you see a lender offering, oh, we're going to pay $5,000 in closing costs for you, how can they do that? Well, any lender can pay $5,000 in closing costs for you, but the way they're going to do it is by charging you a higher interest rate. So, just be aware of people offering things like that, paying significant amount of closing costs, because they're probably just, charging you a higher rate somewhere else to do that. Let's change gears a little bit and now kind of tell you about the home buying process. So what can you expect the steps to take as you get from, your pre-approval to the closing table? So as I mentioned, the first and most important step in the process is to do your mortgage pre-approval, because it's going to give you all of the information you need to know about the houses that you're going to be shopping for. Once you get pre-approved, okay, if I'm looking at a $300,000 house with taxes of $9,000, here's my payment. So anything below there, the payment's just going to be, affordable. You know that it's going to be less than your worst case scenario situation. So get the pre-approval so that you can shop for homes in an educated way and know exactly what you're looking at. Once you have the pre-approval, then you take that and you go find a realtor. The realtor is going to be the person who's going to help you, with the properties and the towns that you're looking at, have that local knowledge to, get you the right property in the area that you're looking for. Once you find a home that you like, they're going to help you to write an offer on that property. So they'll tell you what they think that home is really worth. If it's on the market for $300,000, but your realtor says, look, all of these homes have recently sold that are similar for $275,000, they'll help you structure an offer based on that. You don't want to pay more than the home is worth. Once you have an offer submitted to the owner of the home, you'll go through the negotiation and acceptance process. So maybe they'll come back with a little bit different number, but you guys can meet somewhere in the middle, and then you'll both accept the terms of that offer. Once you have an accepted offer, you'll go into the attorney review process, which is here under inspection and appraisal. During attorney review, you'll do home inspections, you'll do appraisals. The attorney will review the contract that you're signing just to make sure that there's no legal liability and that you're protected financially on the transaction. Once you've finished your inspections and your home appraisal, then you can get your formal loan approval, because until you have an appraisal that tells you what the home is worth, just like you have to get approved for the loan, the property has to get approved as well. And so once you have those documents in, you get your formal loan approval. Once that's all cleared, there's no other items you need to provide to the lender. You'll do a final walkthrough of the property, make sure it's still in the same condition that it was when you agreed to buy it, and you'll get the keys to the home. Now, I want to touch on the importance of having a realtor, because I think it's something that gets a little bit overlooked today with all the real estate websites that are out there. And I do think it's a really important part of the process. I see some of my clients that I work with for their mortgages trying to buy homes without a realtor, and I think that it just gets a little bit frustrating, and it's definitely more difficult. What I recommend is find a buyer's agent, okay, and go through a buyer consultation with that realtor. You want to, do it either over the phone or in person, and just discuss with them your goals. Let them know what you're looking for, the location of a home, proximity to important things like school and work and transportation, all that kind of stuff. Let them know what's most important about the home to you. If you don't have this conversation with your realtor, they're going to be showing you properties that you're going to be turning down left and right, and you guys are going to get frustrated with each other. And really, at the end of the day, it just comes down to communication. If you have a good realtor and you've clearly communicated to them what you want, they're going to find you homes that meet your needs if it's realistic. So you want to make sure you discuss your price point. You want to discuss your property tax desires. Since you've already been pre-approved and you know what those numbers are, tell them to your realtor so that they can show you houses that meet that criteria as well. Because, yeah, there might be houses that meet all of your needs, but if they're $50,000 more expensive than you qualify for, it's not going to benefit you to look at those homes. And so you just want to make sure that they're showing you homes that fit within your budget. If both buyer and realtor discuss expectations, what they expect of each other, that's how you set yourself up for a successful business relationship with a realtor. The best part about having a realtor is that They literally, they work for you for free. So you're not paying your buyer's agent anything. They get paid the day of closing by the person who sold you the house. So the amount that they're making is already predetermined well before you walked in the door of that property. It was determined when the home was listed by the seller. So, having somebody who's going to do all this research and legwork for you and guide you through the process, and you don't have to pay them, it's a significant thing for you. It's definitely very important to the process. Don't expect to be able to find homes on Zillow and Truly and Realtor.com by yourself, because those websites are updated very infrequently. I have clients call me and say, oh, I saw this house, I want to go look at it with my realtor, but then I found out it was sold a month ago and it was never taken off the internet. And so, don't assume that the houses you see on there are going to be available. Let your agent tell you what's available. They have access to the MLS that has the most up-to-date listing on the status of each property. So just let your realtor do your research. Those websites are good for kind of getting an idea of what's available, the style of homes, but a lot of times they're not updated frequently. And so, again, I do think it's very important to have a realtor. One of the things that I'll mention is that I think it's important to have one, not 3 or 4. Because if you have 3 or 4 realtors, they all kind of get the sense that you're working with other people. And so they're not going to give you 100% of their attention. If you don't give them 100% of your business, they're not going to give you 100% of their attention, and it's going to make you a little bit frustrated because everyone's not going to be doing, the best job that they could for you. So I definitely recommend having one realtor. Find that person, have a couple conversations, but determine who you want to work with and stick with that person so that they're going to do a good job for you on the transaction. So let's talk about your team and who's going to be working for you as you go through the home buying process. The first person you're going to talk to is your loan officer. That's your mortgage banker or mortgage broker. This is going to be the person who's responsible for doing your pre-approval. They're going to be your guide to the financing. The mortgage financing is really the tough part of the process today. So you want to make sure that you have somebody who's very responsive, very attentive, and is going to be available from start to finish. A lot of times you call up a big bank, it's like a call center. Your loan just becomes a number, and it can take weeks to get an answer to a simple question. You want to make sure you have somebody who's going to be available and help you through the process. I happen to know a fantastic loan officer. That's my one plug throughout the whole seminar here. If anyone needs to do a mortgage pre-approval or has any questions about the mortgage side of the process, I'm happy to help you and discuss your situation with you. Now, we just talked about the importance of the realtor. So they're going to do all of those things that we discussed: find you homes, schedule showings, negotiate the home for you, have local knowledge. It's very, very important that you find a good realtor to work with on the process. You're also going to hire an attorney. This is important because they're going to protect you from legal liability throughout the transaction. They're going to review all the documents that you're signing, the contracts that you're looking at, and protect you, so that you're not getting in a bad position financially based on the contract that you're signing. They also will organize and oversee the whole closing process for you. Home inspector is someone who's going to come in and inspect the condition of the home, make sure that the roof, the electrical, the structure, all that stuff is sound. And you're also going to have an appraiser who's hired by the mortgage company to go out for you and tell you what the value of the home is. Because you obviously want to make sure that the home is worth what you're paying for it and that you're not getting a bad deal. So if you've signed a contract to buy a house, what does that mean? Well, it means that you just signed a legal document. So you have to make sure that you're signing a contract only if you want to buy that property, because you're going to start putting down money, and there's now a clock that's running that says you have to do certain things by certain dates. So don't sign the contract unless you're serious. There's application dates for your loan, home inspections, appraisal dates, when you have to get your mortgage commitment done by, all of these things. So you want to make sure that you're, if you sign a contract, you're definitely sure that you're going to go through with the process and start diligently following through with all of the things that you have to do. Once you go through the mortgage process, get your conditional commitment, you get your what's called clear to close. Those are the 3 most beautiful words in home buying today. It means you're done with your mortgage, no more paperwork. You can officially go to the closing table, get your keys, and you just became a homeowner. So, all of my information is here. I just want to say thank you so much for attending the seminar and watching this video. I hope that you found it to be valuable. If anyone has any personal questions, please feel free to take down my contact information. It's all listed here. I'm happy to answer any personal questions you might have about the home buying process. I definitely want to wish you all the best of luck. And if there's anything I can do to guide you through the process, I'd be happy to do it. So please let me know. And I hope to hear, many success stories in the near future about people successfully buying homes, armed with the information that I gave you here in this New Jersey Homebuyer Seminar. So thank you so much for attending, and I look forward to hearing from all of you soon. Take care.